5 years ago, I was trading making $100 per trade. Now I've scaled up to making over $5,000. In this complete futures course, I'm gonna show you everything you need to know to understand how futures work, a strategy that you can consistently execute every day, and how to take a small account and scale it consistently to a larger size like I have done. So by the end of this masterclass, you will know the exact path to take to start making a full-time income trading just 60 to 90 minutes every day. I'm gonna go through the whole laundry list of things that you need to know and understand about futures and how they work. I'm gonna just explain you the basics of how futures work, how they're priced differently compared to other assets, why they're actually just better than other assets if you ask me. I've traded everything and I find futures to be the best. What's margin, how it works, what's overnight margin, intraday margin, how they're priced, what is the best place to actually trade futures, and we'll go through a lot of other things and even some tax advantages of trading futures over other assets. And so we're gonna start with the basics and slowly build you up. So after the end of this video, you will be able to have a trading platform and understand how futures work and to be able to start executing a trading strategy with it. Now, futures work differently than stocks in many ways, but once you understand them, it's very simple, just like trading a normal stock. If you buy it and it goes up, you make money. And if it goes down, you lose money. For example though, the big difference is when you buy, let's say 1 share of Apple, you can hold that share as long as you want. You own a piece of that company and it will never expire unless the company goes bankrupt or is taken private. With futures, you aren't actually buying part of, let's say, a company like Apple. You are buying a contract agreement that's value is based on the market it's connected with. So for example, let's say you buy 1 futures contract in the oil market. The contract's value will go up when the oil price increases, and it will go down if the price decreases. The exact same way a share price of Apple would go up or down. So when it comes to the practicality of actually trading this, there's basically no difference. But the only thing is the futures contracts expire unlike shares. The length of a futures contract can depend on what market you're actually trading, but generally it's 1 month or 3 months. This is the one reason why futures are shorter term trading asset. It's not something you hold for a long term. Most people like me day trade using them. That's where the real advantage comes into play. Now technically, when you buy an oil futures contract, you are buying the ability to buy 1,000 barrels of oil at a certain price. That's the nuts and bolts behind it. But in reality, you're never gonna do that. You were just using this contract to get leverage of 1,000 barrels of oil. Because this contract actually costs a fraction of the purchase price of 1,000 barrels of oil. But you get the value increase or decrease of those 1,000 barrels of oil. It's the exact same thing as buying a house with a loan. You only put up the down payment for the house, let's say $100,000 on $1 million house, but you get the increase or decrease of the $1 million value of the house. But you're only putting up a fraction of the total value in the down payment. Now in the trading world, that down payment on the house is not called a down payment, it's called a margin requirement. Just think of it like the collateral that you need to put up for 1 futures contract of, let's say, oil. For example now, if we buy 1 futures contract of the S&P 500 futures, which is a different futures market, this will take about $500 worth of margin. Your account will have $500 taken away as collateral. But when you sell the contract back, you get the $500 worth of margin back. Now this isn't taking into the account the profit or loss that you made on the specific trade you took. So when you see the price of the S&P 500 futures trading at, let's say, 6,000, it doesn't actually cost you $6,000 to buy 1 futures contract compared to, when you buy shares. It's actually based on the margin requirement at the time. Now the market requirement will differ from asset to asset, like oil futures to wheat futures, or from brokerage to brokerage, and time of day. And so let me break down to you each one of those categories. First off, you have what is called intraday and overnight margin. So for example, the US stock market is only open during the New York trading session, which is 9:30 a.m. Eastern Standard Time till 4 p.m. Eastern Standard Time. This is the only time of day that you can trade stocks that are in that market. But futures, on the other hand, are open almost 24 hours a day, 7 days a week. They technically close for a short amount of time after the New York session closes and over the weekend, but this is how the intraday and overnight margin difference is made. If you're trading, let's say, the S&P 500 futures during the New York session, when all other stocks are open in that 9:30 to 4 o'clock window, you only are required to put up the intraday margin, which is generally extremely low, compared to the overnight margin, which is any time the New York market is closed. So for the S&P 500 futures and really any US based futures, it's gonna cost you a lot more to trade outside of that stock market open window. Now, these margin requirements can change based on brokerage. Some of the brokerage have the more normal margin requirements, which can be roughly 5,000 to 7,000 for the intraday. But other ones like NinjaTrader, which is the one I use, can have low margin requirements for, let's say, the S&P 500 futures. One contract can be $500 worth of margin, which is tiny for how much leverage and potential and profit that it gives you. But for almost all of the platforms, the overnight margin is never reduced, which is generally double the intraday margin or around 15,000 for the S&P 500 futures. Now, these are the normal margin numbers. This can actually change when market volatility goes up. Because when the market goes crazy, brokerages will see that there is more risk, and so they'll ask for more collateral, basically. So for example, in the COVID 2020 market crash, the margin requirements were double or triple at times. But it only happens very rarely in extreme times like this. And so it doesn't need to be something that you're super aware of. And generally, you should have enough money in your account to cover the change. Now, another minor difference between futures contracts is you have ones like oil where you're gaining control over a physical asset, or other ones, and if you held that physical asset contract to expiration and used it, you would get barrels of oil. On other ones like the S&P 500 futures or NASDAQ futures, they aren't actually based on a physical product. It's actually based on the index that it follows. So these ones are just settled in cash. But if you're day trading or even just holding them over a couple of nights, you don't need to be worried about having to deal with settling the contracts because it's basically never happens. I've never had this happen to me because I always close them out, or what we'll talk about in a minute is roll them over to the next expiration. You would actually have to hold it into the last week of expiration and hold it probably through the date of it expiring for that to have to happen. But the brokerages and platforms will usually just close you out of the trade as well before you have to do something like that, just because it's a nightmare on their end as well. And I'm sure you don't want to have 1,000 barrels of oil showing up at your front door. And whenever it really gets close to that date, you always trade the new contract anyway. You'll even do it a couple of weeks beforehand. And what this is called is it's called a rollover. And on NinjaTrader and other platforms, you generally don't have to worry about it. The system will either update or send you a message that pops up and tells you to roll over to the next contract. Generally, I always do it a week before because that's most of the time that I've noticed is when the volume picks up on the next contract anyway. And you always want to be trading the contract with the most volume. And all this means is, like in NinjaTrader, you are changing the ticker symbol, which is technically the contract expiration, to the next one. So to walk you through what this looks like, the S&P 500 futures expires every 3 months, and it's always the same month. Essentially, it starts at the new year and it does it every quarter of the year. And the expiration week will always be on the Friday of the third week of that expiration month. So if you have an expiration of, let's say, 3/25, this means it's the third month of the year 2024. And then it will always default to it expiring the third Friday of the month. And all you need to do is, it depends on the platform, but at least on NinjaTrader, you'll generally just click the rollover button But you can also just change in the ticker to just saying 624, because all you're changing is you're just moving over to the next month. Now, some platforms will actually just have letters for the month instead. You can see right here, this is what the letter corresponds with the month, and it will always be the same for every futures contract, no matter what you're trading. But remember, some will do it every 3 months and some will do it every month. Now, when it comes to trading, that $500 worth of margin for one S&P 500 futures contract is still massive for a small account. And so if you're wanting to start with an account of, let's say, $500 or $1,000, what you can do is you can trade what is called the micro futures. All the main futures contracts have them, and they're essentially 1/10 of the size of the normal contract size. So for the S&P 500 futures, which are normally $500 margin to purchase, the micro version is only $50. But also the price movement is 1/10 of the size as well. So your trades are gonna be smaller, but what this does is it allows you, and it's a super simple way to start and grow your small account. I did the exact same thing with my account. I started trading the S&P 500 futures with micro futures, risking $50 to $100 per trade. And then I slowly traded, growing that account, and I increased that trading size more and more. And then I eventually switched to the normal future size of the S&P 500 futures when my account was big enough. Now, the other important thing about futures is understanding how the movement in price relates to dollar change in your trade. For shares, it's super simple. Because their share value is based off of a dollar value, if your share of Apple goes up $1, you make $1. Its value is based on the dollar change. Now with futures, it's completely different. First, the price movement isn't based on money. So if you're looking at the S&P 500 futures and you have one S&P 500 contract that goes from, let's say, 6,000 to 6,001, that doesn't mean your contract value goes up $1. It actually goes up $50. And this is called 1 point. The movement from 5,000 to 5,001 is called 1 point. Think of it just as a numerical change of 1. Now going back to shares, the smallest amount they can move is 1 penny, but that isn't the smallest amount the S&P 500 futures move. The smallest amount of movement is 0.25, which is called 1 tick. It's 1/4 of a point, so it's valued at $12.50. Now this point value and tick size is different for each futures market. So for the ES futures, which is the S&P 500, its smallest tick size is 0.25, and that's valued at $12.50, and the point value is $50. But if we go look at oil, the smallest amount of movement it can do is 0.01, or almost you could say like a penny, and that's called a tick for oil. That's the smallest movement it can do, and that's valued at $10 a tick. So 1 point or one numerical movement in oil is valued at $1,000. But there's way more ticks and movements in that 1 point of movement. And so if you look at the two markets, the amount that they move is drastically different. Oil moves in a lot smaller increments, so the sizing of the contract value with $1,000 for a point makes sense because it's generally only moving between $60 to $80. And the S&P 500 futures, which is valued between 5,000 and 6,000, has a lot more point movement in between there. Now, one thing to be aware of is trading futures, you are over leveraging yourself. For the ES futures contract, only putting up $500 worth of margin isn't your max loss. Technically, you own one contract of the ES futures market, and if the market suddenly crashes, you could lose more than your account or that $500. Now this almost never happens. I've never had it happen to me over the 5+ years I've been trading futures. And there's a couple ways you can protect yourself to make sure this doesn't ever happen. The first way is always have a stop loss in place no matter what. Never move it farther away. First off, increasing your potential risk once you're in a trade, because if the market opens and goes against you really quickly, this stop loss will get you out of the trade as fast as possible, not allowing you to lose more than you were planning. Now you can get something called slippage, where the market's moving so fast, even a market order won't get filled at the exact price. This doesn't really happen that often, and in the end, it's not actually that much money that it will slip. You might lose a bit more than you wanted to, but it won't be a crazy amount. The other way for this to happen, and let me show you on a chart real quick, is if you traded and held through the futures market closing and then opening. And so essentially what that would look like is if you entered in, let's say a buy here, expecting the market's gonna go up, and the futures market closes for an hour after the trading day every day. And so you can see here, if you entered in a trade here, the market closed right at this price and then opened all the way down here. And if your stop loss of, let's say, risking $500 was right here, and let's say your account, is $1,000 and you're only planning to risk a couple hundred here, well, the best price you could have done was all the way down here, which would have been a couple $1,000s worth of loss. And so that's how you could have had an over-exaggerated amount of loss that could theoretically blow your account up. So that's the biggest thing that I would do, is never hold futures into an overnight close, or even over into the weekend when it closes. Basically, when it closes and opens again, that's your big window for having an extreme loss that you can't get out of. And also, this happens a lot because news or, stock earnings will come out right after the market closes. And so when it opens again, and let's say Apple comes out with a really bad earnings report, because Apple's a big part of, let's say, the S&P 500 futures, or if you're trading the NASDAQ futures, it'll make a big drop and a gap like that we saw in the futures contract that you're trading, and you'll take a massive loss. Lastly, the only fees that come with trading futures is generally some kind of routing fee, and then the commissions that the trading brokerage you use. Generally, the routing or trading fees are fixed and will be same across the board, and then futures commissions are based on the brokerage that you're using. But because there's so many big platforms out there and they're all super competitive on the commissions, you're not really gonna find much of a difference throughout them. There's also no interest or fees with the margin that you use. That's for different types of margin accounts, generally trading like stocks on margin. Also, don't get confused with other types of margin in trading and investing that can have interest rates on the margin that you use. That's when you're essentially taking a loan out. For this, the margin is more of, again, think of that like collateral or down payment you're using. And so really cool about futures is the tax benefits that comes with it. Now, I mainly switched to futures because of the simplicity. It's exactly like trading stocks, and it's not complicated like options, but it gives you the leverage that options allow. So it's kind of the best of both worlds. You buy it, it goes up, you make money, and you can do it with a small account and get super crazy leverage. And then as well, on the back end, when it comes to tax season, there's a really cool rule that is applied to it. Now, of course, I'm not a tax professional. This is kind of just what I know from doing it myself and and what's out there just based on the internet. And so when it comes down to it, 60% of your profits is in a way lower tax bracket, and then 40% is in your normal tax bracket, what you make in that year as a normal, like let's say W-2. And so what this allows you to do is, even though you're day trading, it counts in a way as a long-term investment or asset. And you essentially just get to keep more of the money you made. Compared to everything else, you have to hold it for a whole year before it becomes in that long-term capital gains category. And so now let's go to NinjaTrader here, and I'm gonna practically show you some of how this looks like on a real chart. And so this is looking at the S&P 500 futures, the ES futures. We're looking at the main contract, not the micro smaller version. This is the full contract. And you can see over here on the left side this is the price movement, and it's going up in 0.25 increments. Sometimes it might jump a little bit more because the market's moving pretty quickly right now, but generally it'll move up by 0.25. And then if I just click right here, buy market at one contract, you can see that the dollar amount is going up or down in 12.25 increments. And if it moves up 1 point in my favor, that'll be about $50. And so you can see, we're looking at a 1 minute chart right here, the dollar movement per price is very, very large. We're trading one contract here, and you can see over this one small candlestick, I'm already up like $200. And so you can imagine if the market just moves up right here, that's probably like $1,000. And this move right here that took about 25 minutes with one futures contract would have been probably like $2,000. And so you can see the leverage of that money comes into play massively. You know, this costed me $500 worth of margin, and you can see that I'm already basically up $500. And so the leverage there that you can get on a tiny account to potentially make a huge amount is really, really big with these contracts. But again, you can see on the flip side, that $500 I was up has all of a sudden seemed to start to evaporate, right? And so again, leverage can work against you or for you. And so that's where you want to then go into. If I then just, you know, this is just a demo account, I'm not going to just be goofing around on real money here. If we go into the micro futures, you can see it looks the exact same chart, but if I buy one contract now, it's 1/10 of the size. It's going up or down $1.25. And so this is the exact same thing for everything in terms of, if you jump into a micro futures contract, it allows you to now start with a super small account, and these movements for a small account are a lot more manageable. You know, instead of risking, you know, $500 for a small swing, which can seem huge, I could put, you know, enter in here and put my stop loss down here, and I could be risking $20. And I could, you know, my target could be $30. And so this is how you can start with a really, really small account and then slowly scale, because then of course to scale up, it's super easy to say, well, instead of buying one contract, I now want to buy 2 contracts. And you know, see here, this number 2 means how many contracts I have. And now it's going up by, you know, $2.50 instead of $1.25 per tick, because I have 2 contracts instead of 1. And so you can, you know, that's how it's allowed, you can easily increment your size as you go up. And so you can see this movement here is, you know, now I can target maybe $200 worth of profit for, you know, a $50 or $75 risk as you slowly increase your size when you're becoming profitable. It took me over 5 years to make over $9,000 in profits in a single month trading. Today, I'm gonna walk you through the 4 steps that if I had followed when I first started out, would have got me there 10 times fast. The real breakthroughs aren't hidden in the bullet points. They are understanding the nuances and the little steps that are inside each bullet point, especially the last step where I'm gonna show you exactly how to scale your trading account. If you just skim it, you'll likely miss out on key steps that actually make it work. Now, the first big bullet point is quantity over quality. This can seem super basic when you first start out, and in some sense it really is. But I know from experience and teaching other people how to trade, everyone goes through that process of, okay, I've heard that, it makes sense. But the reality is everyone approaches trading in the wrong way of trying to be reactionary to the market and what it's doing. When I first started out trading, I tried to look at all the moves in the market and try and see how I could capture each one. If it was a really strong setup or kind of an okay setup, I would still take them, because what I wanted to do is I wanted to capture as many moves as possible. And what I didn't realize was instead to really become consistent over time, and it took me years of losing to have this really driven into me, is you don't need to be taking 20 trades in a day. You can take 1 trade a week and be consistently profitable over the long run. This is a marathon that you are starting or trying to do. Treat it like one. You do not need to be treating it like a sprint. It's all about timing when it comes to it, and some days or weeks are just not good for trading. It's all about trying to have it fit how you want to trade. Especially when it comes to when you're first starting out, treat every trade like you're in a really big account, or like it's real money if you're starting out on a demo account. If you wouldn't take that trade, on a real money account or a really large real money account, don't take the trade, because the reason why you're taking it is you think it's not that big of a deal, and the idea is, it kind of might work out. The only trades you should be getting in are the ones you really, really believe in and that are gonna be really, really good. I've done that countless times where I get in a not great trade, I still wanna jump in and try and capture that move, because what if it does work out? Another big thing when you first start out is don't over risk per trade. Don't change how much you're risking per trade. Don't risk 50% of your account on one trade. What you need to do is you need to risk a small amount so your account can slowly grow over time. And as well with this is when you're in a trade and you have placed a specific stop loss based on your strategy, do not move that stop loss farther away, increasing your risk per trade. It's really common to get married to a trade to where you think it's gonna really work out and it's still looking good, and maybe the market just needs to go against you a tiny bit. And I've done that plenty of times, and every time it just makes it so I lost more on the trade, and if I got out where I originally had it, I would have got out at less, and the signal for the trade not being good anymore was where I was originally gonna get out. It sucks having a trade that looks so good go against you and not work out to be a really big winner, but that's a part of trading. You don't know when things are gonna work out in your favor. At the end of the day, we're trying to play the math game, and statistically, things are gonna work out some of the time and not some of the time, and you don't know when that's gonna be. I was micro scalping and trying to take 20 trades a day and risk a large amount to make a small amount. And I originally thought, well, if it's a short distance go for profit, well, it'll be easy for me to get that profit. But statistically over time, it made me so, my wins were really small and my losses were bigger than my wins. And what this did to me mentally, every time I took a loss, it felt horrible because it would wipe out multiple wins. It would take me 3 wins to wipe out a loss and get a little bit in the profit. And when it comes to trading, the mental side is extremely important, because every decision you make can be influenced by your emotions. And if you're frustrated, it's super easy to make bad decisions, which is something that derails so many traders from being consistently profitable. And so when it comes to your risk reward, I highly suggest starting out with either a 1 to 2 risk reward ratio where you're risking $100 to make $100. Statistically, you're break even at a 50% win rate, which mentally is a lot better. Same thing if I would also recommend going 1 to 2 risk reward ratio initially as well, if that's what you would prefer, where you're risking $100 to make $200. I think that's even better because you only need a 33% win rate to be consistently break even, and above that, you're consistently profitable with a 40 or 50% win rate. And mentally, it makes it so your losses aren't as big of a deal. For me, losing and having that mental struggle of, oh, what if I get in this trade and I was wrong? Having that pressure on every trade was a lot easier when I could say, well, if I lose, it's okay. I am actually, based on my risk reward, I'm supposed to lose a majority of the time, which seems really funny, but mathematically it plays out in the end. Now, before we go on to the next step, I have created a 90-day trader roadmap. This will lay out everything that you should go through and focus on other than this video over the next 90 days. It'll give you a step-by-step process of what you should be doing on the road to becoming a consistently profitable trader. I'll leave a link for it in the description below this video, or you can download it for free using this QR code as well. Now, I think the number one thing that stops traders from being consistently profitable is jumping from strategy to strategy. I did this for years. I would watch a YouTube video, take a course, and try and focus and learn on a strategy, and I would not be consistently profitable doing it. And so I would then move on to the next strategy. Well, what this did is it would start me over from step 1 again. In reality, trading takes a long time to become consistently profitable at. even if you're taking a strategy from an experienced trader that is consistently profitable doing it, everyone approaches trading differently. We all have different emotions that affect how we trade differently. I get scared to jump into a trade because I'm nervous that I'm making the wrong decision. Well, maybe you're a person that once you're in a trade, you're greedy and let the thing go on too long and you give up your profits, or you take larger losses because you move your stop loss farther and farther away because you get married to the trade and want to let it play out more. Everyone is different, and so that's why it takes a long time to become consistent with a strategy. And so you have to stick to one strategy. Otherwise, you're gonna get stuck in what I actually call now a learning loop of trying to learn infinite things about the market. That's the thing about trading, is there are so many time frames, so many indicators, and what this all does is it really makes infinite ways to approach trading the market. And so how I actually ended up breaking out of this was after a long losing streak of struggling and just feeling defeated, I went back to the drawing board and said, okay, what am I actually good at? And I felt I was good at seeing where key levels of support and resistance were. I felt that I could consistently mark those on my chart and look for reversals at those levels. I felt more confident trading reversals than continuation type trades. And so what I did was then I spent a couple years developing my own style of, okay, how do I profit off of these levels that I'm confident in and then I can draw really well. And so that's where I came up with my strategy of looking for trades in the first couple hours of the US market open. And the most important takeaway of what this did is it allowed me to focus on one simple strategy. Instead of trying to capture every move or constantly add more things to the chart, either indicators or learning more patterns to try and increase my win rate, because logically, the more you learn about something generally in life, the better you are at it. Well, when it comes to trading, more is not better. More is actually less when it comes to trading. Learning more and more patterns or strategies just overcomplicate it, and they don't actually increase your win rate. And so that's why it's very easy for people to get stuck in that learning loop, because logically it makes sense to go learn more or learn a new strategy, but it doesn't actually work that way. And so I would highly recommend just focusing on learning market structure, not really using indicators. You can use one or two, but do not have a ton of them. The simpler, the better in the strategy, I think, because there's so many variables when it comes to trading. If you have too many things you're trying to check off on your list to get into a trade, you're never gonna get into a trade, and it's gonna be impossible to start tracking. And when you start journaling, which is something I highly recommend you do, to actually figure out what's working and what isn't, because there's gonna be 15 different things that you need to be working or not working, and over time, that's gonna be impossible to really know what's making you consistently profitable and what's not. But what I highly recommend doing with your strategy that you decide is you need to write out a plan. You need to make a trading plan to consistently follow what you're gonna be doing every day, your trading routine, what you're gonna do before you open the charts, how you're gonna look for trades and prep for finding those trades. And then once you are actively trading and you're in a spot where, okay, what do I actually do when I jump into a trade? For me, I have like a 4-step simple checklist to jump into every trade that every trade needs to match. And then when I jump into a trade, where's my stop loss going? How much am I entering per trade based on my account size? And then where is my profit target gonna be? Am I gonna do a 2-to-1 risk reward ratio? Am I gonna go to break even at a certain point? You need to have all of that laid out, and not just up to getting into a trade. You need to have rules on how to manage a trade as well, because once you're in a trade and there's real money on the line, or even if you're demo trading it and you're taking it very seriously and it's still intense, you're gonna become more emotional. And if you don't have a trading plan structure to follow, you're gonna end up emotionally trading and making a decision based on your emotions, which is not gonna be consistently profitable for you, and it's generally gonna lead to the bad decision. Now, the most important step when it comes to building your trading account is how you properly scale. Now, I've traded just about every asset there is out there. I've started trading options, I started trading stocks, And what I've landed on after a long time and what I've realized works out the best for starting a small account and slowly growing it over time is trading the futures market. But the idea is that you can start out with risking about $20 to $30 per trade, depending on the volatility of the market, and you can slowly use that to scale over time. They give you a ton of leverage as well, which is important to growing a small account or even trading a larger account as well. And so the key steps that I would follow is to start out demo trading first or practice trading with fake money, no matter where or what strategy you are doing, because I find so many students jump into real money right away, and there is so much about trading that you are just learning. Even just learning the platform, you're gonna make mistakes, and mistakes in trading loses you money. And so the switch from going from demo trading to real money, or let's say a prop firm account, is I highly recommend waiting until you have consistently profited for at least 2 months. Now the reason because of this and that kind of lengthy time is the markets, no matter what strategy you're trading, the markets are constantly shifting. And no strategy is good in every market. There will be people that trade my strategy that do really good in, let's say, a month time because the market is having really good back and forth reversal trades, and every aggressive signal works out really well. But then let's say the market patterns start to shift, the market starts to get a little slower, less volatile, and that trader now is used to saying all those patterns work in a certain way, and they're not able to realize that the market has slowed down and they need to shift how they approach the strategy slightly. They need to be a little more patient and wait for a stronger, more clearer setup, and realize that taking that aggressive entry doesn't actually work anymore. But instead what happens is they take that aggressive entry day after day when it's not working, and they start to blow their account and give up all the profits they had. And now they realize, okay, the strategy just doesn't work. And they go back to the learning loop and they try a new strategy, or try and figure out something that doesn't work. And so that's why I highly recommend trading and finding that consistency for a couple months on a demo trader, because you're gonna go through multiple market cycles in that time. You gotta remember there is some luck involved with trading, because it's just statistics at the end of the day. And if you're, just have a good profitable week, well, you can't just say, okay, I'm a profitable trader and boom, let's go off and, now risk $50,000 on a trading account. Now, once you are confident in your trading and you make that switch, either switch to a prop firm account if that's what you want to do, but I highly recommend starting out with a real money account first with a small amount of money. Because what this does is it slowly introduces emotions into your trading, which is the second key part of becoming a consistent profitable trader. And you have to learn how to trade with those and manage those as you're trading. Trading on a demo account isn't gonna allow you to really unlock that full emotional side of trading. And so allowing yourself to start out with a small trading account and risking, $20 per trade is what's gonna ease you into that. And then what you can do is slowly scale over time. When it comes to account size and risk per trade, I wouldn't suggest risking more than 5% of your account per trade. When you're starting out at a micro scale, it's kind of hard to go a lot less than that. But as your account goes bigger, you get down to risking 2% or 1% or less than that. Risking a small amount of your account allows it so you are less likely to blow up your account by going on a bad loss streak. And when you're first starting out, you're gonna struggle to control those as much. And so you wanna give yourself that time. Remember, this is a marathon. You wanna give yourself that flexibility to be able to bounce back and stay in the game of trading. And so that's why I highly recommend trading futures for starting and scaling over time. In this video, I'm not just gonna break down the basics of chart analysis, but the unique moves and quirks of each futures market. So by the end of this video, you can have a clear understanding of how to analyze these futures markets and charts based on what the candlesticks are doing. And even if you already know some of that basics, understanding how these futures markets actually trade and differ from each other in practice will completely change how you actually trade in your performance when it comes to trading. And so when it comes to trading, a lot of times you start out thinking that I need, 10 different indicators on my chart and all these different things that make it easy to, know what to do, because it seems like an indicator can just tell you what to do. But at the end of the day, if you learn to just do some of these basic chart analysis things, you will drastically improve your trading. And one of those is just learning to look at the major swing highs and swing lows of a market. It will drastically improve your understanding of the direction of the overall trend. And when it comes to actually entering in trades, the biggest factor I always take into consideration, no matter how good the more smaller patterns look, is the overall big picture of what the market is doing, because that is going to rule your trade no matter what. It doesn't matter how good a support level looks or a trend line looks. If it's coming to a major area and your big picture analysis of a trend is that it's overextended and it needs to slow down, well, if you, jump in short right here and you weren't looking at just that big picture, you're going to be losing a lot more trades than you want. And so the basics of, downtrends and uptrends are made by the market making lower lows and lower highs, where just the swings are getting lower and lower. An uptrend is just a flip where it's making higher highs and higher lows. And this really helps you, just this basic structure helps you stay on the right side of the market of saying, okay, well, overall, this thing is mainly making lower lows and lower highs. There can be some times where, okay, it gets a little back and forth here, where it has right here, it had actually more of a quick uptrend before it continued its downtrend. So that could have just been a pullback in the major downtrend that was taking place. And this can also happen because what's happening is you're at a transition period where you are going from a downtrend where it's making consistent lower lows and lower highs, and then all of a sudden it starts making a higher low and then a higher high, and it shifts to an uptrend. So you're gonna have these areas, and these are really key to start to learn, is have areas where it starts to shift. And you want to be aware of that, because that's when the trend is starting to change. If you're either in a trade betting that it's going to go down, well, that's usually a signal to get out. Or if you're looking for the market to reverse to the upside, well, you can take that into account for going long and taking a reversal trade and trying to buy the bottom of the swing. And so a super helpful thing with identifying a lot of the swings in the market, and this is just going to take you time to understand, is going through, and you can use things like a trend line. And so how I like to draw trend lines is if I just use a quick drawing to kind of show you before we look at the charts, because no chart really looks like this. But a lot of the time what you want to do is you want to essentially just match the highs. The idea with the trend line is you're matching it to all the main swing highs that you're seeing. And then on the flip side, you can also make what's called a channel, where essentially it's both, where the market doesn't do this a lot of the time, but it can sometimes make a channel where on the upside, where the pullbacks, they will respect a downtrend, and then on the swing low side is they'll also basically be respecting a downwards trending support line. And this is a downwards trending resistance line. And so what those do is those essentially make a channel, and they make it really easy to identify what the market is doing. Now, because the market is always changing, now a clear kind of one is actually on a bigger time frame right now. This is the NASDAQ futures. So how you want to draw a trend line and start one is, you'll see here we're looking at the big swings here, and then it makes a high here, and then it starts to just trend lower. Now, you're not going to know these right away. It takes some time, and it usually takes at least 2 swings to be able to draw that trend line before knowing it could bounce off of it a third time. And so I like to at least wait for 2 swings to draw it off of. And so here, there's this big swing up here and this swing right here. And so for me, I would take a drawing tool and start it at the swing high here, and then draw touching this next one. And then so here you can see the market came up here and it didn't quite touch this if you put it to exactly the highs. But so that's the big thing about any tool or drawing tool you use in the market with support or resistance, trend lines, anything you use, take it with a grain of salt. You can have some flexibility in it. It's not gonna be, okay, well, it didn't touch my line exactly, so I'm not gonna, it didn't count, right? Think of it more of like a zone. This is a big thing I do, and we'll talk about it in a minute with my support or resistance levels, is I don't think of it like one line. I think of it as an area where, okay, well, the market will come up here somewhere and reverse lower. Versus this, you know, it's a big line. I don't wait for it to come exactly up here. So if it's coming up here, I'm thinking, okay, well, it's close. And you know, if a trade set up off of that, then I would take a trade off of it. And so once it finishes, well, then I'm going to adjust based on that, because I consider this to be a pretty clear touch and a reversal. And so going forwards, again, I would look at that and say, okay, well, extend this out and see what happens. And this is where trend lines and everything become very subjective, is you can match this either with the highs, or you can also drag it down here and say, well, it kind of, there's all these bodies here. Well, if you do that, you can see that this got a lot closer here and made a lot more sense. And so that's where drawing tools can be a little tricky, or drawing trend lines can be a little tricky, is it can be very subjective, because you can see here, well, once we got down here and down here is what pretty much was touching these ones as well. And so that's kind of how trend lines work. And so that's why we're drawing them. My kind of rule of thumb is take it with a grain of salt. It doesn't count as a break of the trend line if it, you know, breaks by one candlestick and goes back in, or it has a wick that breaks above. A clean break of a trend line is where the candlesticks clearly break out here like this. And so kind of on the flip side, what that can look like, just to find you a quick example here, here's another just moving back in the chart a little bit. Here's kind of a trend line right here I would consider. And you can see here, it's clearly broken that. And so at that point, I would say, hey, I think that this trend is over. The potential there means that it could either go sideways or it could reverse to the upside. And so from that point, you know, you would use whatever other factors you're using, an analysis like support zone here, I already have drawn on the chart, or just looking at the big picture, where are the big swings in the market and kind of what's been going on. So at that point, it looks like, okay, yeah, it's kind of bouncing, and I would look for, you know, kind of a move off of that. And so when it comes to practically using trend lines, they're going to be broken pretty quickly a lot of the time. And a good example was actually this morning in gold, where on actually a 1 minute chart here, is it had a really nice bottom here and a trend line up. And so the market just followed this for a while until it eventually broke. And so you can have multiple types of trend lines where they're really sharp here and just kind of very fast paced, or like that bigger picture downtrend one they were looking at. And even gold actually has one going on right now too, is zooming out to more of a bigger picture 15-minute chart. As you can see here, it's got this, you know, it made a larger swing high right here, kind of a double top, and then it's had two clear swings here, and then the third one I think pretty clearly bounced off of that. And so another example here is on the flip side. You can see on the bottom end, I've drawn a swing off of these two, and then there's this third one right here. And so it looks like it's clearly starting to bounce there, find some support. And so that's how you can start to use these as clearly predicting where the market could slow down and reverse. Now, one last one is, I call it a spike and channel, or a spike and trend, where a lot of times in a beginning of a move, the market right here, you can see it does a quick spike where it just moves very rapidly in one direction, and then it starts to slow down into more of a methodical trend. Now this one's still pretty tight here, but you can have it essentially on the flip side too, on an uptrend where it goes up and then it starts to go into more of a healthier trend. The market has a lot of different types of trends where, you know, they're unhealthy moves like this, where they're likely to have a pullback or consolidation at some point, or more healthier moves where, you know, like this, if we zoom out, where, you know, it's slowly moving back and forth. And that's more of a range bound move. And when it comes to trading futures, I've always found it to be very important to stick to when there's more volatility in the market, because trading in, a choppy market, this is the NASDAQ yesterday on a 5-minute chart. This is the whole day of trading basically. And this is the first kind of 2 hours. And you can see it just sat here and did nothing. And so that's times where you kind of want to stay out and not watch the market too much and save your money for a day where you have more volatility like this, where there's more moves that are more tradable. And so this is where time frames are really important to pay attention to. You can trade whatever time frame you want, but when it comes to futures, I highly recommend sticking to entering your trades on either a 1-minute chart or a 5-minute chart. And then bigger picture, you can look at, I like to look at a 15-minute chart or a 30-minute chart for kind of understanding the broader picture of what the market's doing, drawing these kind of bigger swing moves. And that really helps you understand the big picture of what's going on, because you can easily see, okay, based on just the swings of the market right here in gold, that it's pretty back and forth right now. It's kind of in this downwards tightening wedge that's going on. But just looking at this and not really analyzing it too much, you can think that, okay, well, just based on what it's been doing, it's kind of been going back and forth with some moves in between. And so when it makes this move, well, it's probably likely to move back up, because the market likes to just repeat what it's doing most of the time until obviously the trend kind of shifts. But when it's in this kind of back and forth mode, going into a larger time frame to see that and understand that is really important, because then you can go into a 1-minute like this or a 5-minute and enter your trades more accurately near the lows of that swing. And you could enter in right here betting that the market was going to go up, capture that swing, and you could get something like 4 times your risk in your profits. And so that's why timeframes are really important, and especially day trading and intraday trading, because when it comes to futures, intraday margin is very, very powerful. And the real reason why I think it's good to trade futures, if you're trying to swing trade futures, I think there's other better, safer assets to do that. But when it comes to day trading, futures are really, really powerful because of the low margin requirement that some brokers have. And so that's what I use when it comes to trading. I use a 1-minute and a 5-minute to enter, and a 15 and a 30 to analyze my charts. So let's talk about the theory of supply and demand first. And so if we're looking at just like, let's say, a market of gold, well, as the price of gold is really low, there's going to be a low supply of it because there's not that many people wanting to sell it. Why would I sell, this gold bar that I think is valuable for a really low amount of money? But as the price gets really high, more and more people are going to think, well, hey, I want to sell my bar of gold because I can get a lot of money for it because the price of it is really high. I'm getting a lot of value. But then on the flip side, for demand, well, if something's really, really expensive, like a bar of gold, I'm not going to want it because I don't want to pay that much money for something I think I can get for a lesser value later. And so as time goes on and as the price goes down, demand actually increases. And so you have imbalances where supply can be really high, but no one wants to actually buy it because it's overvalued. Or times where demand is really high, but nobody wants to sell it because they don't want to sell it for dirt cheap. And so in the middle here, that's where you have more of an equilibrium where buyers and sellers meet. And so when it comes to actually trading, what you can have is, and what you create is supply and demand zones. Based on stuff that we'll talk about in a minute of how you identify these, but based on past observations, you can start to create these and know that, okay, well, when the price comes down to this demand zone, it's likely that it's oversold, that the price is so cheap that there's likely to be a high demand, which will, over time, increase the price because more and more people want to buy it. And so the supply actually starts to dry up. And so if there's a finite amount of something, the price is going to go up over time as more and more people buy it and more people want it. But eventually it's going to get to a point where it's at a price where more people want to start to sell it because they can get a really high amount of money for it. And so the price will go down. And so quite often you'll hit these extreme areas and have strong moves off of them. And then you'll get into that more middle ground between the two where it has that equilibrium and it'll have more of a choppy market. And so this is why when you look at a stock chart, it's important to understand that these extremes are the important part to pay attention to, because you'll likely have the market bounce off these zones quickly and, like I said, chop around in the middle. And then it will, once it comes up to a level, you have that potential to reverse off of it. And so that's how you want to look at trading these levels. And so this is how I like to use them for trading, is I like to watch for key areas where I think that the market might find a supply or demand, and it's likely to reverse off of the supply and demand zone, and then you can capture a nice swing off of that. In this trade right here, the market came down to this demand zone down here, and I bought, went long, and captured a move up and made about $1,500 on this trade. And then as it came up to where I thought there was another supply zone, I got out of the trade because it's likely that it reverses off that zone. And I wanted to get out of my profitable trade and move on with my day. Now this is horizontal supply and demand zones. What you can actually have is trending supply and demand zones where the market is moving down slowly and it continues to move lower over time. But what you get is it starts to bounce off of supply and demand zones as it creates those. And so you can start to take trades as it tests these levels. Another way to do this is it can actually be created with more trend lines. And so every time it comes up to that trend line, you can think of it as a supply zone. It's just more horizontal. A good example of this is a trade I took recently where the market had a demand trend level down here that I wanted to take a trade off of. And so it bounced around, moved up higher, and then sold off to that level to where I thought, okay, it's likely that the market starts to slow down here. Waited for a setup that I like. A few key patterns that I look for every time that I'll talk about in a little while to enter in, confirm the trade, and then I waited for it to play out, and it eventually played out, moving up to the higher end of the range, and I was able to get out for a clean $1,200 trade pretty quickly. And so that's how I use supply and demand, because it's so powerful to simplify trading. There's so many indicators and concepts when it comes to trading, and I always found the best way is to focus on just one or two things, and supply and demand really changed that around for me. So I want to talk to you about the key concepts that I use every time I draw supply and demand zones, so I know that it's actually powerful and it's likely that the market actually reverses off of it. Otherwise, it's so easy. Going into our first concept, it's so easy to draw supply levels everywhere and not know which ones are gonna hold and which ones are gonna break. And so for me, the first biggest thing is not looking at those levels in the middle of the range. I like to stick to then at an extreme of that supply and demand in the market versus being in that middle of that area, and you could have a chop and just not have something that's worth taking a trade. And so that's the first key concept, is stick to extremes in the market. I always find that for my trades, even though I have a 3 to 5 step checklist I look for every time I enter into a trade, it doesn't matter if everything on a 1 minute chart is aligning up perfectly and it looks like it's gonna have a great trade. If the big picture isn't aligned and saying like, hey, yeah, I think that we could bounce to the upside, or that we're at a extreme where the overall price is likely to have a snap back, then there's no trade. This is the most important thing when it comes to executing and confirming my trades, is things being at an extreme and also the big picture being aligned with what I think is gonna happen. Now, when it comes to drawing these zones, what I like to do is I like to see at a minimum multiple touches. So in terms of here, there's this swing right here, and then there's these two touches right here. And so what I did was I said, okay, hey, I think, when the market was trending nearly where it is right now, with that bounce we just saw, I go back this is me going back almost a month in data to find this level. And so I go based off of, okay, we have the extreme down here, and then we've also got a couple of bounces here. It looks like we kind of had a head and shoulders here, but essentially there's some chop in here and some bounces. And so that's, I think, okay, it's, why I draw a zone, and then I'm just gonna drag it across here to where essentially the current price is. And as the market came down here, I said, okay, I think it's likely we bounce off of here. And then it gets a nice, really clean double bottom. And then I go into a smaller time frame and look to see if there's a nice setup right here and I can catch a big swing higher. And so the reason why I draw zones instead of very specific lines for my horizontal levels is because it's a supply and demand zone. You don't know where exactly it's gonna bounce. It's gonna bounce somewhere in this area. Every time the market comes down and tests a level, things are gonna slightly change. Maybe the market will come down here and barely test it here, because in this instance, when it's coming down to this level, well, there's some news out, or for some reason, a lot of people want to buy it now, and it's gonna bounce way sooner. Or it pushes further down, people are less interested in buying it until it gets to an even deeper extreme. And then that imbalance happens and people swoop in, pick it up quickly, and then it rockets up. And so that's why you can see there's a big rocket in this case. And so that leads into our next concept, is when there is a massive move off of a level, I like to key into that as well. Because if there is really aggressive buying or selling, it means that a lot of people came in the buying side, there was a lot of demand. And so it makes it more likely that when it comes back in the future, people are going to want to buy it. Or on the flip side, if there's a big selling, it makes it more likely that people are going to want to sell when it comes up to this area. Now, most of the time, I like to just look at the last few days for a lot of my levels, because that's the most recent price action, and it's more likely that something's gonna happen based off of that. If you zoom really far out and you have a level all the way from back here, when the market touches that again months later, I find that a lot of the time something has changed at that point, and if it comes all the way down here, I'm gonna look for that to potentially break. Now let's talk about some keys of how do you know to the best of your judgment, because you never truly know and can never truly confirm if a supply or demand level is gonna hold, it's how the market comes into that level. And so you have multiple trends where either you have a very fast-paced, extreme aggressive move, or you have a healthy trend with methodical pullbacks, where it sometimes even breaks the trend, moves around, chops, touches the zone, and then continues to chop a little bit. But essentially, how I see it is when the market has a very fast-paced move like this, it's more likely to bounce at a zone just like this move right here. And the reason why is because it's an unhealthy move. The market, when it just has an unhealthy move in general, even if there isn't a supply or demand zone, it needs some kind of pullback to create that equilibrium. And when it hits that extreme of this supply and demand theory graph, there's gonna be so much supply in the market. If we quickly go back to the concept here, is because if it shoots down so fast, there's some crazy momentum pushing it and pushing and forcing price to be so cheap down here. But at some point when it gets so cheap, people are gonna start buying it and sellers are gonna eventually start to dry up, and you will have what is called a V bottom. And so you have that right here in this case. It actually did almost a double V bottom where it came down, spiked, supply kind of pushed it down lower one more time, and then as it hit here again, people came in and said, no, this is an amazing price, and it rockets up from there. And so this is how a volatile market works, because supply and demand is all over the place. And that is really, really good for trading. And for likely that a level will hold. Now, sometimes you'll have it to where it just blows through a level, and those are easy to avoid. And that's why one thing is, we'll get to my checklist in a minute, of why you have a reasons that you look out for to jump in and buy in an area like this. You don't just blindly say, hey, I'm gonna put in a limit order down here, a buy order, that when this price comes down here, if it does, I just wanna get long no matter what it looks like because I think it's likely to go up. Well, that's not always true, because supply can be so powerful that it blows right through this level, and you have to look at the next level. And so those unhealthy trends, when they do start to lose a little momentum, I find it's likely that it reverses, and those are the best trades. Now, when a zone is more likely to break is, if maybe we can find a quick one here, is this was a pretty good zone right here. You know, this was a zone I was watching for a while. We had multiple touches up here. You could even drag it down and take this swing. This is a clear swing where it came up to that zone, bounced off. We had a lot of chop up here. It eventually sold off. And when the market came up here again, well, I'm looking at the big picture. And so the big picture is we've come down, sold off. There was a big news that caused a spike. The whole time after that news, the market was just kind of chopping back and forth. And well, pattern-wise, this is a bull flag right here. And if you look at the lows, they're essentially getting higher and higher. Every time, after the first couple times, the market would make a push up here, the swing low would get higher and higher. And what that means is people are coming in and buying the extremes that where it gets pushes to the downside sooner and sooner. And so as it starts to, in my eyes, has a healthy move up here where there's moves with ups and pullbacks, and it starts to kind of sit here, and you know, it kind of sat here and chopped around for a while, and it sold off, and then it comes up here and starts to sit here again. To me, that makes it way more likely that it continues higher. And this is actually one of the trades we looked at a minute ago that I just quickly showed. This is where that trend line of trending supply and demand worked out as well. You can also see as the moves move up, it creates those with the swings. And so this is the cleanest one right here where it popped up, sold off a little. And so you could say, well, this is a micro supply level, came back down to here, broke that, hit another supply level. It was kind of the highs at this point. Big area where it's likely to sell off, sold off, and then at this point you have multiple touches here to where I drew this trend line. This was actually before market opens, where it came up and it hit this demand trend line and also hit this previous supply level that turned into a demand level. So that's the interesting thing as well, is levels when they're broken can flip. And so in this case, and this happens all the time, where you have a high and then the market breaks that and it comes back and tests that high. And you can see this all over the market. If you just zoom out and kind of look, you can see here's another concept of it happening where the market came up here, put in a high, kind of sold off a little bit, broke above that. And then if you pretty much just draw these highs, it came up, bounced off of it, and made an attempt to keep going higher before the market started selling off the rest of this day. Now, where you can get in trouble is over analyzing. And that's why I like to stick to where it's just super clear and really obvious what's going on, and staying out of insanely choppy times like this. The market, the last couple of days here, you can see these are the opening days, and then this is kind of the overnight movement. Every day here, the NASDAQ here has pretty much just done nothing. There's times in the market where you'll have movements that are just terrible for trading. Every strategy has market conditions that are crappy. My strategy is more of a reversal strategy of taking trades off of either big trend lines and looking for a move down, or off of, good support lines and looking for moves up off of those. But any time that the market is just sitting here chopping like this, and you can even go to a 1 minute chart. Today had some good movement for the first time, but if I zoom in on this day, you can see it's just back and forth. If you zoom in, it looks like maybe there's some good movement, but big picture again, there's really, really little movement to capture. Or continuation markets are terrible when the market is in more of a range bound or reversal volatile market. And so that's why it's really important for you to understand what markets are good to trade in and what aren't. And the biggest one again is choppy markets, and just learning to understand and read, okay, well, when is there a big movement and volatility? That's when you want to start paying attention and looking for potential trades. It doesn't have to be necessarily looking for reversals. It could be looking for continuations if you think the trend is really strong. Again, that's why you look at the big picture and say, okay, what do I think is happening? And if we look at and analyze this, well, the market was in a big downtrend, and then it started to have this support level. Well, I think when it breaks this support level, it's had all this consolidation, which is really healthy for the market. And so once it breaks, it's very likely to have a large move in that direction because it's broken this support level. It's not overextended. It's unlikely to fake lower and continue higher, because also looking to the left side of the chart, there isn't great support levels to look at. It had a kind of a pretty strong trend up. And so big picture, this trend could be reversing and having a pullback before, it does whatever it's going to do next. And that's where if you wondered what this would be doing next on a bigger picture, you could zoom out even more to, let's say, like a 60-minute chart or even a daily chart. And that's where, ignore all the random little drawing time frames because those are incorrect. We're on a daily chart right now. But, looking at a daily chart, this is where I would think, okay, we're in a clear big uptrend. We might be having a bit of a pullback here, but I'm assuming we're in an uptrend until we have a clear pullback and a double top and something's starting to fail here. And that's where time frames are really important to understand. Of just because on a daily chart right here the Nasdaq is in an uptrend doesn't mean that if I go to a 5-minute chart or a 1-minute chart, I'm not going to be looking for a short on a shorter period time frame. You can still be looking for shorts and longs. It just depends on what time frame you're looking at and what those time frames are telling you about the market. And so what's really important and helpful is understanding just basic candlestick patterns. What these will do for you is, once you kind of understand how to read markets, you don't really need these, but it's a good cheat sheet when you're first starting. Because if we look at this, here is a descending triangle, and it's basically saying, okay, the market has a horizontal support with a downwards trend line, and the trend into it was a downtrend. And so once it breaks this to the downside, this support, it's saying it's likely to continue lower. And if we look at our Nasdaq chart, well, you can see we pretty much had a downwards descending triangle right here where it had that support level and then a downwards trend line. And then once it broke that, it had a really big move lower. And so that's a really good way to use these and match them up with what's going on to help you understand when you're starting to learn these as a beginner. And so when it comes to actual candlestick patterns as well, these can really help you break down some smaller patterns of what could potentially be happening right at these inflection points. Now, these are all reversal patterns. Once you kind of understand what they mean, it really makes a lot of sense. And so, for instance, here, this one, it's a V reversal because you have a trend coming down quickly, and then you have a hammer candlestick pattern where the market essentially just goes like this in that one candlestick, and then big picture, it continues higher. This candlestick pattern, essentially on a smaller time frame, what I'm drawing here is it essentially just makes a double top. And a double top is a larger, bigger picture structure reversal pattern. And these ones right here they are a momentum switch where the market is going down, in this case really methodically, and starts to slow down. And then you have a massive switch in momentum. And so going through this will really help you understand how these can work. And another one is essentially consolidation, where the market either here it has it in a form of just a doji, or here it has it in the form of multiple candlesticks, where it has a downtrend, it starts to just go sideways, and then it moves up. And so this is also something you can get if you get that 90-day trader roadmap. It'll just be emailed to you as well. And it's really something that is, I think, really helpful for understanding candlestick patterns. Now let's jump into the top 6 candlestick patterns I've used over the years. These are common candlestick patterns that you will see that, based on their structure and the market psychology of what the data is showing you, commonly will play out in a specific manner. Now the first one of these candlestick patterns is called the engulfing candlestick pattern. It's just a 2 candlestick pattern, but what it signifies is that it's a reversal pattern where the chart is coming down, and if you see this pattern, it will signify that it's likely that the price reverses to the upside. The idea of how this works is you have a bearish candlestick that is engulfed by a bullish candlestick right after it, where the open of this candlestick is lower than the low of the previous candlestick, and the close of it is higher than the high of the bearish candlestick. The whole idea is it is a massive reversal happening, where it completely blows out the previous candlestick. And this can happen on the flip side for the bearish version too, where a smaller bullish candlestick is engulfed by a big bearish candlestick. And again, the idea is that it's a reversal candlestick, and likely the market is going to reverse after this. And this is a great confirmation for an entry, just like the trades I showed earlier. But again, you don't want to just blindly be using it by itself. The next one of these patterns is called a pin bar candlestick. This is where the importance of wicks comes into play. What this can help us do is, it's another reversal candlestick pattern, but the idea is that you have a big bullish candlestick followed by what's called this reversal candlestick. This large wick is showing us that the price tried to continue higher and was rejected. It's showing you a flip in the momentum of the market that this is representing. The price was previously moving higher, and a topping pattern is gonna flip the price of the market. And this candlestick here is showing that. And followed by it, to complete this pattern, is a nice bearish reversal candlestick. After this, the idea is that this is going to reverse lower, and it's a confirmation that you can use to enter into a trade. Same thing goes for the bullish version, where it's coming down, reversing in a big way, and it's indicating that the market could continue higher, reversing that trend that it was in. This is how you can start to read the market like a book. You can start to use these patterns and slowly build upon them, connecting them so you can eventually read a whole stock chart clearly. This next candlestick pattern is called a 3-line strike pattern. What it's showing you is there is a clean, methodical uptrend in the market, and then it is broken and reversed very rapidly by this huge engulfing candlestick that engulfs multiple of the candlesticks before it. It shows you a massive switch in momentum and a massive increase in momentum in the other direction. And so how you can use this is, again, bullish or bearish side, is that the market is switching from a slow methodical move lower to a rapid move higher. Buyers are really stepping in, wanting to buy at this level, which is likely to continue to push the market higher after this pattern. Again, these patterns are super powerful, but you have to stack them with other indicators. Now that we can start to get into some larger patterns, and a flag pattern is a key pattern that will help us understand how to read dojis. And so how this pattern works is it's a continuation pattern. The idea is the market moves up and goes sideways. It essentially creates a flag. The idea with this is the market's had a really strong move higher, and it's now just taking a breather. It's coming to a point where it just needs to catch its breath. It's a little overextended, and this pattern often signifies a continuation, that it could continue higher, that this momentum that it had before is just taking a pause and it's gonna come back in and push the market higher. But what will often happen is you'll start to see dojis here when it flags out. And dojis are okay if there's a couple of them, but once there becomes too many, you can start to get trapped. If we flip over to the bearish version here, it's the same thing to the flip side, where we have a strong momentum to the downside, but then it starts to go sideways. And the key to knowing if this is really gonna continue, or it could do what I call a failed breakout, where it attempts to break lower and the market actually reverses, trapping people and making this pattern cause a false signal, is when you start to get a lot of dojis stacking up. When you start to see the market just sit there for too long, that's when the momentum has really just dried up and it's not taking a brief break. The idea with this pattern is it has a large momentum move and it just takes a quick break before it continues higher. If it starts to take too long of a break like this, that's when you want to stay out. That's when the dojis can really start to give you some insight that there is too much indecision in the market and it's likely to not have a clear move in either direction that is easy to trade, and you should stay out of the market. I used to fall for this all the time myself. This pattern right here looks really clean, right? But this can easily turn into what I call a failed breakout, where the market pushes lower and then immediately flips on you, reversing higher. There's one key missing step that is really good to know to tell the difference between if it's actually gonna break out or do a fake out. And we're almost to where we can talk about that, but I wanna first talk about a few big picture candlestick patterns that are really gonna tie this all together for you. The first one of those is a pullback pattern. This is a super simple market structure pattern, but it'll start to connect some of these dots for you. The whole idea with this is, here's the bearish version, which means the market's gonna reverse, is the market's coming up in a nice solid trend higher. It pulls back and then it pushes one more time up. But then what happens is you'll notice we get an engulfing candlestick pattern right here. And what that signals is it's putting in a lower high right here. This swing, if you kind of just think about it like a line chart now, is the market made a high here, pulled back, made one more high here, and now is pushing lower. That high is lower than this one. And in the big picture structure idea of the market, that is a big reversal signal. If you couple it with this engulfing candlestick pattern, this starts to become a powerful signal. As soon as this engulfing candlestick pattern here is formed, you can use that as a confirmation to enter in on a trade with the idea that the market is going to push lower based off of that. Same thing goes for the bullish side. But you can see on the flip side, same thing. But you could have a different candlestick pattern, making this, you can even call it a double bottom. This is how you start to look at candlesticks and create larger picture structures in the market that can signal key areas that you want to pay attention to. So you can start to see this pattern and the flag pattern are very similar in a lot of ways. How do you know when a pattern is going to either continue or when it's going to fake you out in the opposite direction in reverse? Which is why in a minute we're going to go over how do you know when it's actually the right time to jump into a trade versus when it's important to stay out so you don't actually get trapped and lose money. Now before we go further, if you want a downloadable guide that goes through all of these candlestick patterns, I've created a free 14-page PDF that you can download for free in the description of this video, and it will go into way more patterns with way more detail that I highly recommend you get. You can download it in the description of this video or via this QR code. Now the last one of these is called the head and shoulders pattern. It's a big key reversal pattern, but again, it's really powerful when you couple it with the indicators that really confirm whether an area is worth taking a trade or not. The whole idea of how this works is it's looking at the big picture structure of the market. It's essentially looking at the swings of the market where it's making in an uptrend, it's making higher highs and higher lows consistently, and then all of a sudden it switches to making lower lows and then lower highs. What you'll start to notice about these patterns is that they're very simple. You do not need complex patterns to understand what the market is doing. And keys with this head and shoulders pattern is on the bullish side, where this is gonna signal, we're gonna make a reversal to the upside. This key is you want this final extreme low that it makes to be strong and then it to reverse quickly. Essentially, it's showing you the market got overextended, accelerated to this side, and then buyers came in a big way and pushed it to the upside. This final pullback here, and really adding this pullback pattern that we talked about earlier, essentially what it's doing is it's showing you, it's giving you the confirmation of, okay, is this gonna just continue lower? Because, well, it could just continue making lower lows and lower highs here, but once it creates this bottom here and really starts to form this candle and this candle, that's when you can confidently say that, okay, it's starting to shift. And that's how you use these patterns to understand what the market is gonna do. Now I wanna jump into the personalities of these major markets. What I trade the most is the NASDAQ futures, the S&P 500 futures, gold futures, and oil futures. And these all four have different personalities and how they react to a lot of these patterns that we've gone over. They will react differently to them, respect them in a different way, which makes it really important to actually practically trading these, because when it comes to, looking at a move like this on gold here, I'm gonna approach it differently than a move like that on the ES or the NASDAQ. And so first I wanna go over the ES futures. And the major things that I think about it is, I think one, it's great for beginners because it's very methodical and a lot more predictable. I think the moves in the S&P 500 futures are a lot more solid. It doesn't have as many fake outs in one direction. It's not likely to spike one way and then go the other as often. Take everything with a grain of salt. Of course, you can have, a spike like this and then a reversal, but it's not gonna be as volatile as something like the NASDAQ. And so the NASDAQ, one thing about it is it's more volatile compared to the ES. If you look at the NASDAQ in the first 30 minutes here, or let's just say an hour, it was pretty volatile. And if we look at the ES in the first hour, just to adjust here, it was more volatile, but it wasn't as all over the place. The moves were a little different. And what this shows me is that it helps me realize, and I think as a beginning trader, if you're watching the ES here, instead you will realize that, okay, it's more choppy, it's back and forth, the market's not really sure what it wants to do. And then when it has more of a breakout in one direction, you can see that, okay, that is a stronger move, and you can make a decision if you think that's an actual solid breakout or it's a failed breakout. Versus the NASDAQ was having moves all over the place very fast. These candlesticks right here are huge, and that can be a lot harder to trade in. Now, obviously the NASDAQ and the ES are very correlated most of the time. Sometimes you'll have the ES where it's more choppy and the NASDAQ is more movement. And so that's mainly the only main difference between the two in terms of direction. The NASDAQ could be doing something like it's selling off because it's, more tech focused, where the S&P 500 futures could be actually moving up or just kind of going sideways. And I think if you're looking to trade just one, which I think is the better way to start out, because trying to look at both can be a little confusing, I would stick to the ES futures because they are more likely to not fake you out and give you a better directional movement. Now, when it comes to respecting trend lines and levels, I have found that the NASDAQ and the S&P 500 futures will sometimes break a trend line after the move has already started. So what I mean by that is let's say we have a trend line right here. Well, I will sometimes see that if we're coming down to a support level here, the entry to jump in the trade is before the signal of it breaking the downtrend. Now, I don't always do this. I would say if you're a beginner, don't do that. Wait until it breaks the downtrend clearly, because again, that's always a very obvious confirmation, but there's times where the market can move really fast and it makes sense to jump in before it actually breaks that downtrend. But in that case, I'm using it with the idea that I think based on what I'm seeing, it's gonna break that downtrend. Now, when it comes to gold, I've noticed that gold is way more methodical and respects its trend lines more than the S&P 500 future and the NASDAQ. You know, I had this trend line right here, and I would not take a trade to the long side, big picture, until it broke this downtrend. Now, on a smaller time frame, you totally could jump in on a long here like this guy, because the idea is, well, if you jump in long here, let's say on this pullback, you're gonna be in the profit before it hits where it likely reverses here. But like for this, if you were in a trade long right here, betting that the market was gonna go up and you were making money as this goes up, as soon as this breaks this trend line, I'm gonna get out of the trade, because likely with gold that it's gonna either start going sideways or go down, or you know, maybe it'll continue going up, but the trend is over that I wanna be following. Same thing down here, is it had a really strong trend this morning after that kind of move. And then once it broke that, my thought was, okay, well, it might reverse or it might go sideways. And you know, again, looking at other factors, I didn't actually think that this was gonna go up, because you can see the bigger picture is coming into play and pushing this thing down. Also with gold, I have found that a lot of the time entering in on a 5-minute chart is actually better than a 1-minute chart. Now, the only time I do, just because again, it's more methodical and slow moving. Now, when it has some volatility, like it had this morning, like this move right here, and you would know that the volatility is happening because these candlesticks here are showing you that the volatility is happening. And then, so when it starts to bounce here, I would jump in somewhere right here on this pullback and bet the market was gonna go up, because it's had that volatility and I can get a trade signal based on that. And same thing here, but you know, for other reasons I'm not gonna jump into too much, I would think jumping in there on a 1-minute or a 5-minute would make sense. And so kind of on that note, going back to the ES and the NASDAQ though, I think you can trade both. Again, some of that is always gonna be personal preference. A 1-minute chart is always gonna be more fast paced, more intense, and more likely to trigger your impulses and have you, you know, jump in on a trade when maybe you shouldn't yet, where a 5-minute is always gonna have slower, more methodical, stronger signals. But I think you can kind of do both. What I like to do is I like to do a 1-minute for generally my, you know, I like to trade and look for reversals in kind of the first 30 minutes. And I like to use a 1-minute for that, because a 5-minute is a little too slow for a lot of the whipsaws and movements that happen in that time period. Now, the last one here is oil futures, and oil is a lot trickier than these other markets, I think. Now, I probably take a trade in oil once every few weeks or even months, because a lot of the time it's very kind of choppy and back and forth, and then it can have just a big move out of nowhere. And what that's from is it's because it's very news driven. Is you can see if we go on a 1-minute chart here, looking at this, you can see that it's moving almost nothing. Is because of how the candlesticks look here. It's even gapping between each one of these lines is a tick, which is, you know, the smallest movement a futures market can have. And so oil, just based on these candles, you can see that it just looks super, super choppy, and it's just not moving at all really today. And so even on a 5-minute, you can see that, okay, well, it's still pretty choppy. It's having some kind of methodical moves, but most of the time, you know, it's just not really doing much. Now, if I look at a 1-minute chart, yesterday, it did have a decent little spike lower. Now, actually, I think it's set up on a 5-minute chart better. And so that's where, you know, sometimes a 5-minute is a little better. And it doesn't mean just because on a 1-minute it's choppy, it doesn't necessarily mean it's bad to take a trade on a 5-minute. But you can see here, it had a little spike lower, came to actually a support level, and then started to bounce. And you could have kind of caught this initial spike and then maybe this trend higher. But it's a lot trickier and I very rarely take trades in it because they don't set up very often. But when they do, they're good trades. That's why I like to watch it and keep track, because it can still have really good moves. I figured out the simplest scalping strategy that turns losing traders into profitable ones. Not only has this strategy worked for me, but it's also worked for other traders who have tried it out, and they have turned into being consistent over the long run. I've compiled a ton of real trade examples, so by the end of this video, you will know exactly how to execute this strategy just like these other profitable traders. To give you a super quick overview before we dive into the nuts and bolts of how you can consistently execute this pattern yourself every day, all I do is when the US market opens, I look at the first 30 to 60 minutes. All I'm looking for is a clean support and resistance level, and then I look for a few key patterns. For example, right here, there's a nice double top. All I do then is I see a nice candlestick pattern, and then I enter in on a trade short, betting that the market is gonna go down, and then from there, I let the market play out. I've noticed over time that the market consistently has a reversal in the first 30 to 60 minutes of a trading day. And so what this strategy does is it allows you to take advantage of that reversal, and then coupling that with looking for key areas of resistance or support, you're able to essentially ping pong the market between those levels, capturing a big potential profit for a smaller amount of risk. And this is all I do every day. This is the only thing I look for every single day. And it allows my trading to be super simple and straightforward so that you can go into every day with a plan and know how to execute it. Instead of what I did before when I was unprofitable, I was trying to match what the market was doing, and that just was not profitable. And I know from teaching a ton of people how to do this, that's the exact same way they feel as well. Let me walk you through how I entered and found this trade. And so initially, what I'm seeing is you can see that the market had a nice methodical trend up here. And then this bearishness right here showed me that, okay, something's changed. We've broken this uptrend. That's a massive thing that I like to look for. And then also this big trend line right here is drawn from a bigger picture, where on a 15 or 5 minute, I can see that the market consistently is coming up to this level. It comes up here again, it's likely to continue lower. Obviously, if I see the 3-line strike pattern that I like to see, and a couple of other factors. And so seeing that it had this big bearishness here, that was a great confirmation to say, okay, the momentum in this market is switching. You always want to take that into account. We came down here, had a little bit of a bounce, showed, some momentum. Essentially, you could even say this is a 50% pullback from this area. You can see it's literally in the middle of that box. The market likes to do pullbacks like that are literally halfway of the move it just had. And so it moved down this far, it pulled back halfway, that's what this little spike here is, and then it sold off. And for me, this isn't a super picture perfect and really nice looking 3-line strike pattern, but for me, I saw, okay, there's some movement up here, there's this big attempt to go higher, and then, it's essentially in this little mini channel, and then this big candlestick here, especially with the fact that it wicks higher right here, this little wick right here, it's essentially like a micro double top. And then I get in, I actually got in down here a little bit because it was moving pretty quickly, but the signal there is at the candlestick close right there. And so that's what I used to jump in on this. And then of course, put the stop up here. Doesn't need to go all the way up here above this trend line. What we're trying to do is risk a tight amount and then have the big picture potential for the market to really start moving in our favor. And so in this trade, I think I'm risking like $500, but that's why you can use this kind of in any account size. You can scale it up because again, trading is super scalable. You just use and find one pattern that works and then increase the money. You don't need to try and find more patterns to make more trades. That's what kind of kept me from being profitable initially. And so you'll see here actually, once the market essentially made a pullback here, right here, and then moved down, I moved my stop loss to break even because I want to kind of tighten up the trade and get out if it's gonna pull back on me. Sometimes the market's just gonna be choppy and all over the place. I don't wanna trade in that. I wanna be in trades, and I've noticed these trades will work out pretty cleanly in your favor if they're gonna work out. And so from there, you know, it starts moving down pretty quickly. I'm trying to see, okay, is there this downtrend line that I can kind of expect the market to pull back to? And again, that's kind of thinking about, okay, how am I managing this? You know, as you are trading, you want to be thinking what to do next based on logic, not, okay, I'm up, you know, almost $3,000. You know, I'm really nervous. This is a lot of money. I need to get out. Or what if this keeps going? I could be up 5,000, 10,000, right? You can't let your emotions kind of control what you do. You need to have a logical plan to trade with. And so once this kind of got rocketing in one direction, it gets really far away from the trend line, and I don't want to hold through a pullback. You know, at this point, that's a big pullback to hold through for it breaking that trend line. And so I start using kind of more of a tighter trailing stop loss with kind of previous candlestick highs. And you can also see there is this blue box down here. That's a support level. And so big picture, I've looked at, okay, well, the market's already bounced here a couple times. If we come down here again, I'm gonna expect that we're gonna bounce or slow down. And this is a really fast moving, unhealthy move, which is great to be in if you're in it, but it's likely to snap back at some point. And I wanna be out when it's gonna snap back. And so that's why I have kind of a tighter trailing stop loss. And you can see it's starting to snap back a little bit. And I wanna give it a little wiggle room because, you know, these things can break through a support level and keep going lower. But in this case, it kind of starts to chop here, it makes a double bottom, and it essentially knocks me out here. But I get, you know, about $3,500, $3,200 worth of profit. So now that you have a good understanding of what I look for every trade, I want to zoom through a couple more trade entries so you can get this repetition down. Because at the end of the day, trading is very repetitive, but it's all slightly different. Every trade entry has something slightly different about it. There's gonna be something different to learn and take away from every different trade entry. So when you try and do this yourself, you have that pattern recognition in your mind. We're gonna jump into one more pretty in-depth walkthrough so you really have a good understanding of the trade entries. And then also, I'm gonna show you a couple trades of doing this on a small account. You can do this starting with $50 to $100. I had a whole challenge where I took $50 and turned it into over $3,000 using this strategy. And now let me kind of give you a deep dive into the checklist I use for each one of these trade entries and how to know why the fair value gap is gonna really reverse versus, you know, before a lot of people will try and see that fair value gap and kind of buy here looking for it to go long. And sometimes that'll happen and I'll avoid those trades because of a few key factors. You need just the basics of this fair value gap to be popping off. And the biggest thing is having a bunch of them compared to the trade today I took. That'll really increase your confidence because when the market whips up that high, that fast, it's really likely to give it back up because of, remember, that imbalance in the market. That's what really makes this so powerful and allows you to, when you trade, to enter in and risk a smaller amount or have a good risk reward ratio to where you can be risking, you know, $100, $1,000, doesn't matter what your size is, but you're going for 3 times your risk. That's a massive key when it comes to trading. For me, I have found that's way easier to be successful at. And so kind of the first thing is you want those fair value gap indicators. And then second is coming up to this resistance zone. You have to have a key level to be trading these off of. You do not want to be just trading them randomly. Here's a clean example of really just right before this trade happened is where this is big indicator of overextension, right? But you can see there is, if we kind of zoom out, there's not really a good clean level. There's kind of something here, but if you really zoom out, that's middle of the range. The good extreme level is down here. I'm not gonna go over how to draw key levels in this video. I'll link a video up here on how to do that properly. But that is why, and a reason why you wanna stay away from something like this, because there isn't a good zone to reverse off of. You need to be waiting for there to be a really clean zone like this. And then going into a 1-minute chart, because I like to trade on a 1-minute chart right when the market opens. I'll take a 5-minute entry a little later sometimes, or if the market's a little slower. But in this case, I took it on a 1-minute because it made a really nice setup. Now, another huge factor in this trade is there was timing. I have 3 kind of timing windows I look for, and the window this one aligned up was 30 minutes after the market opens. I constantly see reversals happen at that time, and so this is another catalyst on what makes this a really good setup. And then kind of the final thing is, you have this uptrend that's broken, but a big thing is looking at the structure of the highs and the lows, the swings. And so here, in an uptrend, it's making higher highs and higher lows. And so I need to see that stop and it make a lower high. This is a massive key factor here. And so from that point, that's when I look to jump in the trade. Sometimes I'll look and say, okay, I like a 5-minute better, but the 5-minute kind of just chopped here pretty good too. So when I was actually trading this took a long time to get going. On a 5-minute, it looks pretty simple, but on a 1-minute, it took about 20-30 minutes to get going. And when I was trading larger than normal size, I put $1,400 of risk on this trade. My kind of normal large size is 1,000. And because this was such a good setup, I did a little extra because of how confident I was in it. And so it makes just the waiting even that much worse. And so eventually though, it punched down here, moved to break even, and set a limit order here at 2 times my risk. Essentially, a good target is the bottom of the main move. That's the easy money if you ask me. And then after that, my thought was, okay, I will trail this thing and let it keep going if it's gonna keep going. But if it has a big pullback like it just did, I'm gonna get out and call it a day. And so the first thing, of course, is using those 2 indicators is to see that we're coming up into a key resistance zone. Again, you can draw these yourself based on that other video, or I do have an indicator that does it pretty well automatically. And the second thing, of course, is this move was overextended based on the other overextension indicator. So you have those 2 keys showing up, showing you that this has a high probability to reverse. That is the biggest confidence booster when it comes to trade. And this is what honestly helps me focus on the process as much as possible, is always making sure that you have those 2 keys in place before you even sit down and consider taking a trade. It helps you just avoid all the noise when it comes to trading. And so that's honestly the first thing in the checklist, is having a key reversal zone and having an overextension indicator signal come up. The next thing is having a key reversal pattern. What I like to do is look for either a double top or a head and shoulders, or even in this case, it did essentially a fail breakout here where it broke above the previous extreme high, got a lot of people in excited thinking it was gonna go higher, and then reversed. And so this candlestick right here gave me a ton of confidence. And then the final confirmation was that it had this little pullback here and then push lower with this big candlestick, confirming a lot of momentum to the downside. And that is where I essentially entered in on my trade and then used my risk reward calculator tool here to put my stop loss up here and target a certain amount of risk. You want to try and keep your risk the same every time. And then as this moves in my favor, I slowly move my stop losses down. And usually the initial target I have for these trades is if it gives back up that overextended move. But you always want to try and let it run a little bit more just in case it's going to keep going farther. So this trade right here had a pretty big spike down, and I closed out right here for pretty much $2,000 in under 15 minutes in the morning. Here's another example, and this is on the flip side, looking for a long. You can see clearly I'm looking at a support level here where the market's bounced once, twice. There was probably another bounce here before on the previous area in the chart that I was looking at. And so I'm already looking for the big picture of the market to come down here and bounce. And to accurately enter and confirm that the market's gonna bounce here is I looked for the market to make essentially it slowed down here, and then it had a strong bullish candlestick here form, and I got in essentially as it was about to finish closing. I got in a couple seconds earlier, but I essentially got in as it created that 3-line strike pattern. And you can see here, it was actually a candlestick after the bottom here. It wasn't right away, but it was still showing me that switch in momentum. And it gave me an accurate entry to enter in at the bottom of the swing, have a tighter stop loss, and then capture the reversal back higher. And so this is super, super powerful for capturing trades like this. You know, every trade is gonna go slightly different. We're gonna go over that massive one here in a minute, but this is still a really nice trade to capture, you know, $400 or $500 worth of profit. Again, just trading 60 minutes in the morning. And so at that point, you know, the market kind of slowed down. I said, okay, I want to get out if it breaks lower because it could just give that swing back up. And that's where I kind of got out at, about $400, and moved on with my day. Now, this is a good example of a trade on a small account. I'm kind of doing a small account challenge right now, and this is on a small account. And so I'm risking $100 here, betting that the market is going to reverse off of this resistance level that I've drawn, and then, you know, betting it to go probably kind of down here. And we'll talk about targets and why that's a good target later. But if it gets down there, that's a good 2-3 times my risk. And on a small account, risking $100, that is a nice profit. And so the first thing that I'm looking for, obviously, is that it comes up to that level first, right? That is the number one key thing to make reversal trading work, is the patience to just wait for the market to come to an extreme and key level. You can even see the market came here and reversed off of this little area right here. You can say, well, you know, it bounced here, it bounced here, it bounced here. And so maybe it bounces here. Maybe I should have got that. You know, maybe you even look at hindsight and say, oh, I'll try and get that next time. But those don't work very often, and they're more likely to cause you to lose money in the long run. It's better to just sit out, kill that noise, and wait for the market to come to these extremes. And then when it's oversold or overbought in this case, you can capture on that strong reversal to the downside. And so the first key that I like to use is after it's kind of hit that level, again, you can see it's not quite in my zone, but again, it's so close, it's good enough. The first thing is making sure that uptrend is broken, because when you're counter trend trading, you don't want to go against a trend because, you know, it might come up to a level here, but it's in an uptrend and it's just going to keep going, right? We don't know, these levels aren't going to hold every time. It's not just blindly sell or buy at these levels. And so that's kind of why I have this uptrend here, is you can see that we had strong bullish candlesticks here, and then it kind of started to break. Is it had a doji here, it had a bearish candle here, and then it made kind of another push higher. And so for me, that's good enough to say, hey, yeah, this strong kind of micro trend right here is broken. And you can see the market's kind of being quick with its reversals. And so I'm okay with thinking that that's a good enough trend break. Certain kind of trends, they'll need something else. But in this case, for this kind of very one-directional, unhealthy trend, it's good in terms of clearing that kind of need for a reversal break. And so after that, my next key that I like to look for is kind of a reversal pattern or reversal candlestick pattern. And so in this case, the market started to show some weakness here with this kind of doji here and this kind of red bar. And it broke that uptrend. And then it made these two candlesticks here, these bullish candlesticks, breaking this previous high. This high right here became a new one. And for me, that said, okay, it's still going higher, but as soon as this big bearish candlestick form right here, this big red one, that to me is showing it almost made a micro failed breakout. It made that kind of trap where it attempted to make a new high, and it did. It made a new high, but barely at all. You know, it didn't make much before this big bearish candlestick came in. And so if I kind of zoom back in the recording and kind of show you that in real time, right now to speed this up a little, once this candlestick finishes forming, I think that's a good signal for me. And I want to get in right there at the low of that candle. So my thought is, okay, I want to get in when it kind of breaks the low of this candle, because to me, that's a strong enough signal that it's likely going to reverse there. And so you can see initially, it kind of starts to go against me and doesn't look great initially. But that's where when things reverse, sometimes they take a little while. The market won't always just reverse on a dime. A lot of times it'll come up like it did, kind of start to settle down and slow and lose some of that momentum and strength, and then it'll give it back up and start going. And so that's what I'm kind of looking for. And so once I entered in there, I moved my stop above this high, because the whole idea is if it comes up here and knocks me out, I'm looking for that kind of quick reversal to fail. And I think if it comes up here, comes back down and keeps going higher, I think that's a stronger uptrend. It's had a healthy pullback if it does that, and then it keeps going higher, and I want to get out. The idea is with trading is you take your stabs, they either work out really quickly and really well right away, or they just don't work out and you move on. If you're trying to force a trade in conditions where it's just not great and not working out, you're gonna lose money if you try and enter in the market over and over. And a lot of the times when the market has a big move like this, kind of like we were talking about earlier, that it's a big area where the market velocity off that area was really big, it's more likely that when the market comes back down there, it's gonna find a bounce. And it's gonna find some buyers and support. And this trade right here is going to dry up and slow down. And I wanna capture my profits here because I'm getting, about 2.5 times my risk on this trade. And that is a great trade to just consistently make money and grow your trading account. And again, that's what you want to start out with. You don't want to be trying to get home runs, make a ton of money. Make your small account grow over time, and then you can 10x this size. I have trades on my channel where this trade would be $2,000 and it's the exact same setup. And so actually at that point, you can see I had my stop loss down there because I was managing it pretty tight because we got down to this area, and it closed out there and it actually started to reverse, and you can see it started to reverse off that level. So now that we've mainly focused and you have a good understanding of entries, what you need to learn now is how to manage the trades. I have a couple different styles of how I manage them, and you'll start to understand them throughout this section. It can either be going for a fixed profit target or managing the trade fluidly. This is really important to get down and understand because the entries are the most important part, but being able to maximize how much you're getting from every trade is very important for your long-term profitability. And so essentially at this point, this is where I'm thinking, okay, I wanna see a large candlestick here form because that's gonna help me with step 3 and 4 basically. It's gonna show me a double bottom, and then it's also gonna be that strong engulfing candlestick that confirms that. And so right here you can see I'm using essentially a tool to say, okay, if I enter here and my stop loss is here, how much do I want to enter in on the trade? And then where is, my risk reward ratio is going to be. And so essentially, once I wait for that to confirm, I like to let the next candlestick play out a little bit because sometimes a big candlestick like that can have a bit of a pullback before it keeps going higher. Minor detail. But essentially what I'm looking for now is, okay, I'm gonna enter in long at the break of this pattern and as it goes higher. And so what I do is, you actually see there's no order here on the screen, but I've entered in a long here and put my stop loss down here. The only reason why it doesn't show up is actually just because my account on this recording screen wasn't selected for a little while. But if we zoom forwards, you can see I entered in here and I put my stop loss below here, essentially the bottom of that swing. The whole idea of why I put my stop loss there is because I don't want the market to, if the market comes up here, makes a pretty clean higher low, and then comes up and breaks that, I think the trend's gonna continue lower. And so I just want to kind of get out because I'm getting mixed signals. I want the signals for the trade to be clear and for me to jump in on the trade. And so with this trade, I think I'm risking about $800. And so as we move up, I'm looking at a few key factors to manage it. And so to walk you through how I plan to do this is, well, obviously the major swing I'd love to go for is somewhere up here. That would be holding overnight, multiple days. And that's not really what I was looking for today, especially because it's a Friday. It's going into a long weekend actually with a holiday on Monday. Now, obviously you didn't know that, but just looking at
the patterns here is, well, the market's starting to kind of slow down. And so there's potential resistance zones here where I think the market could slow down. I also think a big picture, kind of more looking at a 30-minute, is if we look at this, well, the major kind of swing down it had when it started to accelerate was kind of this area right here. And so I would think a good spot would be to give back up to here if it really started to get going. And so that's essentially what I'm doing every time I'm in a trade, is I'm thinking about where are the potential for not necessarily major, you don't necessarily need to be targeting a major swing or a major supply or demand level, but also looking at these smaller ones, because now that we're in a trade, those can still reverse the market. They're not necessarily where I want to enter in on the market, but they are at a spot where I want to potentially get out or take some of the trade off. And so right here, you can see as the market started to push up here, it's had a really nice move. It's essentially given up this major move down. I have moved my trade to break even. It's really important to take that risk off the table, because going forwards, well, I don't want it to come up here all the way down and I actually end up losing $800 on the day when I was up over $800. That's just kind of, math-wise, you gotta kind of go with that. And the helpful part is it had this little micro pullback here. That's when I kind of moved it up. And then from there, in a minute here, I put in a limit order at this high here because I wanted to say, I don't want to manage it in real time. I want to just get out of half of my trade of one of my contracts out of my two when it punches up to this level. And so right there, you can see it closed. And so I closed off, took about half of my profits there. And then with the idea is that I'm buying at the major support here. I want to see if this will continue higher and I can get even more out of this. But I don't want to be greedy. It's at a definite spot where I think it can slow down. And so I want to take some off. And so that limit order that just showed up there, I put it up here in case we did just skyrocket up there. That was the spot I wanted to take the trade off. At that point, I would have been super happy. I think it would have been 4 times my risk in terms of profit, at least for half of that trade. But going back to the concepts that we talked about, you can see I have a trend line here. And this upwards trend that is going on here is a very unhealthy or one directional trend. And so my thought is I'm okay holding this as long as it holds this trend line. But as soon as it kind of starts to break that, it could pull back in a big way. And at this point, I'm thinking that, hey, this is a great move. I don't want to hold through a big pullback and push higher. I was able to break up my trade into maybe having a smaller amount on here. And so at this point, I was essentially just watching this and saying, okay, I'm gonna get out. And so just to zoom forwards here, is it had a little bit of a bottom here, moved my stop loss up there, and then it eventually broke that right there. And so that's how I take this whole process and turn it into a step-by-step checklist that you can now use for yourself. See the market kind of start to show kind of a bottoming pattern. Right here, it's basically making higher highs. And so I like this, as this candlestick was a really kind of a big bearish candlestick attempting the market to go lower, and it failed here based on these candlesticks. And so I like the idea of saying, hey, I want to get in long above this candlestick right here, betting that the market is going to go higher. And so I put what is called a buy stop order above it. If the price of the market touches this price, put in a market order. I don't care where you fill me at, just get me in the market. And most of the time you can see it literally just filled at that exact price. But sometimes it can, fill you right here because the market can move pretty fast. But that is the order I like to enter in on most of the time. And you can use a buy limit order that'll get you in below or exactly at that price. But the problem with that is, well, for this example right here, well, the market kind of took off here and you would have felt a lot of FOMO, and because you would have missed out on the trade, and you would have had to wait for and hope that the market comes back down and fills you at that price. And so you can see here quickly, just over a couple candlesticks, I'm already up $1,000 on this trade, risking, you know, I think $500 or $600. And so this is where the power comes into play. Is I'm trading 4 oil futures contracts here, and you can see it's moving in that 0.01 increment, that penny size, compared to the S&P 500 futures that we're just looking at was actually moving in that quarter of a point size, that 0.25. But you can see here clearly that the money is a lot more. And so for me, my strategy is I like to kind of get in when I see, you know, basically you can easily see here is there's a lot of momentum here. It started to slow down by essentially just seeing that the market kind of started chop here. And then I look for a few key factors to jump in and catch the momentum to the other side. And so I moved my stop here to break even. And then as it starts to kind of get pretty accelerated here, I like to use kind of the idea that, hey, okay, I'm gonna give it a little bit of wiggle room, but I am gonna move my stop up if it pulls back, because, you know, I'm up about $2,000, and, you know, you wanna let this thing run if it's gonna run, but you also, you know, you can see like just as it pulled back right here, it can reverse very, very quickly too. And so that's where I really look to, you know, manage my trades. But again, that's come with a lot of practice and experience trading this. You know, my target here, you can see now that we're getting up to here, you can see we're kind of in a support level that I've drawn from previously in the chart. And that's where I'm gonna expect things to slow down. And so you can see I've moved my stop loss up here. It's, you know, we're up a lot more money now. And this is where kind of the power comes into play of using technical analysis with futures. Is you have that leverage and you have that ease of getting in and out of the market, but you also have the simplicity of, you know, you're not having to deal with the complexity of options and other factors that come into play with other assets. And so to close this out, you know, I'm not gonna go into my strategy too much here. I have a lot more videos on that, but I pretty much get knocked out right there. So now that you know pretty much the nuts and bolts of this strategy, I want to show you some live trading examples. These are recordings of trades I took and me in real time, not just kind of going back over and kind of explaining a trade I took in the past. This is what it's like in real time. This is super powerful for you to now understand what it's like showing up to the morning, analyzing the market as I see it in real time, entering a trade, managing a trade, and going through the emotions and how I control the emotions and don't let them control me for a trade, and to be consistently doing this every single day. Okay, well, it's time to lock in. The market is seriously moving this morning. 15-minute chart of NASDAQ. We're coming up to basically, I think that's pretty much all-time highs. ES is not quite there, but it's a previous high. And then also we have oil here is doing a pretty big sell-off, kind of just back down to this kind of support area. So I like it for a bounce off of this big move down. I would like a double bottom though to some extent. It does have news right here. So we'll see if that sets something up. Mainly, honestly, what I'm looking at is this NASDAQ move right now is pretty crazy. We've got news at 8. Not big news, honestly. The 8:30 is oil. These are, you know, not West Coast times. Then FOMC is in a while. So this move will be done by then. So I just want to see if it kind of looks like it's going to reverse here at kind of 45 or 8 a.m. Kind of quick early morning reversal. See what happens. Just going to quickly let my room know what I'm thinking. I would prefer a 5-minute, but like big picture, this is a nice spot. I really like that we are at the all-time highs here. It is a lot of movement, strength, I mean. This is broken. But the main thing is that there's
the fair value gap is basically saying, hey, it's super overextended. It's super overextended into, oh, sorry, smaller chart, into that previous high. I mean, even a pullback down to like here somewhere is great. It's 54. This news coming out is, let's see, pull up this tool I have. Let's see, it's wholesale inventories. So at top of the hour, wholesale inventories is not a big release, so it shouldn't really matter that much, and I can actually trade through the release. So that's kind of important to know. If this sets up beforehand, I can pretty much say I'll just get in anyway. So I might enter in the ES instead. This moved back to a lot more. Which one is up? So the Nasdaq is up 0.8 this morning while the ES is up 0.6. So it's definitely moving more. But I would like to trade the weaker one because that's generally the better way to go. I mean, a little bit more of a pullback than this. Um, 2 minutes on the news. That's right there. Just trying to take. I do want to full size this actually because this is a really nice move at a good area. Gold actually looks strong. This is gold on a 15-minute. Gold looks like it's going to bottom. And it's somehow showing strength when the market is showing strength. And so I think that's kind of helpful for this. Okay, news is popping up after this candlestick here. Oil is still kind of doing its thing. I'm not really concerned about that right now. I'd rather focus on this. Comparing these two still, the Nasdaq is showing still more strength while the ES is showing more weakness. I do want to be aware that this could just pull back and continue to shoot higher. But again, I want to be aware that that's okay. I still want to jump in when a good signal shows up because it's at a good area that makes sense. You know, I don't know what the market's going to do, obviously. I just want to jump in when it makes sense. Like this is a nice little stab higher. NQ is actually making a new high, wow, while the ES is not. So I think if NQ looks like it's gonna fail, that's what I want to jump in on. Like this, if this fails, like putting in an order below this low, because on a 5 minute, I think that would still look pretty good on a 5 minute. Because also big picture, if I pull up targets for this potential, I mean, it's the easy money would be giving this move back up, but then we could push lower to here, which would be like, this is 3x, this would be like 6x. which would be obviously a sick move. I don't think that's super likely, but wow, so that does look good. I do want to get in short but right, like I think I want to get short here. It's just a little nerve-wracking with the NQ being but again, like that was a fast move up. So I'm nervous about this, but again, the reasons to get in are good. NASDAQ, it could have just got, you know, this could just be like a final push higher and that fails. This candlestick right here is pretty strong. It's just an attempt at a new high and then it's gonna fail. I would like to see how this does this kind of bottom here and then continue higher. But I think if the NASDAQ gives up, this is gonna push lower. So I think I'm gonna put in an order below this. It's a good setup. New high, lower high. Big picture is good. And I'm gonna put my stop above the highs. And I'm gonna manage accordingly. Nice failure there. Again, like the big thing is this could just come down and bottom and continue higher. So this point, just kind of let it do its thing. See how it plays out. Again, like this. Looking, even on a 5 minute, that's a nice 5 minute candle. But we'll see what it does. Also, if you're wondering what trading platform I'm using, it's called NinjaTrader. I've used it for over 5 years. It's amazing. I'll leave a link in the description below this video if you want to check it out. Okay, I think this is not gonna work because let's be honest, your trades never work. But it looks good. It looks good. In all reality, that's a nice little poke higher. Let's look at what gold looks good. Pray that gold goes up. That'll help. Oil, I don't like oil I suck at oil longs, honestly. And when I look at it, this is just, I think, FOMO over seeing this move. Really, the sick entry was this bar right here and catch that move down. Otherwise, it was just not worth it. So I mean, like if it bounces, but it's got news in 20 minutes, so unlikely. Again, it's pretty nerve-wracking because there could be just a lot of strength here, and it could just continue up. But again, the main thing is it's all about just following your plan, because this doesn't have to work in every time. Even if it works 50% of the time and I get 2x or a little bit off 1x, like, it's great. And this still is setting up, it's still at a decision point. Not out of the woods, but I think ES looks good. I'm gonna sit on a 5 minute. See what that looks like. I'm gonna move it. It was not in a good spot, to be frank. The reason why I like it to be above the high, because if the market came up here and, like, let's say reversed right here, knocked me out, but then did a big bar down, I would still want to be in. But I would have been out of the trade. Like, it's not violated until it breaks up here. It can come up here and then do a failed breakout back, failed sell off back in, but usually that's unlikely. So this is not selling off quickly. I would say it doesn't look good. I think if this lower high here on the Nasdaq doesn't turn into a head and shoulders and start going down, I'm going to want to get out. Because at that point it just looks like it's probably going to continue higher. I'm just going to go step away for a while because this is driving me a little crazy. And I think it's going to not work out, even though NQ is actually making more lows. NQ looks better than the ES now, but this trading, you gotta sit here in the agony of indecision. I think because of it being kind of like this, once it gets to break even, or 1x, I think I'm gonna go break even. Unless it just gets moving quickly. This is when just looking at a bigger picture 5-minute chart just makes it way easier to drown out the noise of it looking good or looking bad. We're just looking for a push. Of course the Nasdaq is now selling off better. Classic. You choose one and the other is better. Now I'll just turn this on for kicks. I want to move to break even now because if it just shoots up after that, I'm just going to get out. Like, just get me out of that. I'm going to take off 2x for sure down here if it just blips lower. Yeah, just that's a nice start. It could totally just reverse up after that though. Would it suck to just get out at break even? Yeah. After all that. But as a part of trading. Alright, I'm looking for this move. It has stabbed through most of this move already, which is kind of rough. But I can also, if it starts to slow down, I'll trail a little bit. Like I'll trail previous candlestick. I'm just gonna give it a minute here and see. I gotta manage my stupid recording pages. Okay, I'm going to trail with 2 with the previous candlestick. It looks like it's just gonna basically get knocked out. Oof. I really want to pull this down. It literally just almost blipped it. Okay, it filled that. My computer is literally lagging. Okay, I'm moving the rest down here. It's a 2x. I want to give it some room, but also like, I'm not going to give it, you know, crazy room here. There we go. That's fine room right there. I'm gonna give it this candlestick because it's clearly NQ hasn't even given him the move back up. Big picture, pulling up the 15-minute chart again just to see where we're at. Again, the easy money is kind of over. But I don't, so it's like I'm giving it some room, but also like I'm not gonna give it like one, you know, a crazy amount. Like this is the move I'm really looking for. I'm not really looking for this. Like that's more if it just rips lower, you know. Sick trade. That just came out of nowhere. I was not expecting that to happen. After this chop, I was like, I'm screwed. I've lost for the day. Well, okay. Okay, so the market has been open for 15 minutes here. And looking at the NASDAQ futures and the ES futures, the NASDAQ has a pretty good uptrend in place as well with the ES. And so I would say there isn't really great constructive support levels. You know, we might come down here and bounce. It looks like we're kind of selling off right now. But if you look at both of them, we had a really nice move up yesterday and a sell-off. But right now, it's just kind of chopping in this bigger sideways trend still. NASDAQ has broken out a little bit more. So it's definitely looking on the bullish side overall, but also kind of weak at the same time. And so in my eyes, that's kind of just indecision. And so it makes me less likely to want to touch it. Gold here is having a, kind of zoomed out on a 15, is having a big move up here. It's kind of been chopping around for a while, but now it's had a big move yesterday, and this morning it's having a second one, and going down to a 5-minute. Like this is a nice uptrend that I would love to try and short. But the problem is if we zoom out to like a 30, there's just not a great level that it's at yet. You know, I'd love it was if it was popping up here. Here there it's, you know, kind of had some chop, and there's some previous tops over here, but it's still just not great. And so I'll look at it and see, you know, watch it and see, okay, well, does it set up a really nice, clean looking, like double top kind of situation where I can at least catch a move down to here, especially like maybe on a 1-minute chart if it looks like it'll reverse a little quicker. And then oil is just kind of crappy looking. It's just kind of in the middle of the zone. Maybe if it pops down to here, but at the moment, its current trend is just kind of just a sloppy downtrend. You know, that's not interesting. You know, I want to see something overextended and, you know, popping up a bunch of fair value gap indicators on like a 50-minute chart, like oil. I mean, gold here. I mean, that was a 30-minute technically, but, you know, again, very one-directional. Getting overextended, it's gonna have to have a pullback at some point. That's the main thing. There's also some news 30 minutes after the market opens. In terms of severity, it says it's orange. I think this one actually is Richmond Manufacturing Index is actually green from my sheet, so theoretically, it's not that big of a deal, but it will be up here in like 10 minutes. So I'm kind of waiting to see that, see if we can get a reversal in the NASDAQ. I think that's kind of the biggest option at the moment, especially after this reversing off of that because we're just kind of in a sideways range. There's also this low. They're not great lows to be reversing off of because we haven't like tested it multiple times. But with these early morning reversals, sometimes that's all you need. And so I'm okay watching that and taking a quick stab on those on a 1 minute chart. Okay, this is sold off really fast on the NASDAQ, and generally when this happens, it could V bottom and I'll totally miss it. But also, we've broken below this low I like. We could totally get a failed breakout here. But I want to see, if I'm going to take a long, I need to see how it comes up and tests this level. Because otherwise it could just come up here and keep selling off. And when there's this much momentum in this case, you don't want to just try and jump in long out of the fear that, oh, there's a ton of this crazy move down and I can catch the whole swing up kind of thing. That's not what we're looking for. I didn't get long on this initial candle because it just needs to kind of break with the overall bullishness or bearishness happening. I almost need like a higher low here, even though this is technically a higher low. Just having a little bit more confirmation would be good. The sizing here isn't great for half size. I'll probably double the contracts to go like 600 risk, which would end up being like 700. But I mean, overall, like, just doesn't look great. And this is how you weed out crappy or not great trades when you're unsure. But if this comes down here and pops up, I want to get long. And I think I want to get long 2 contracts because that's what I was just looking for, and I think that's a good enough confirmation. I'll be nervous about it because I'm a little back and forth on the read, but I think this is a good spot to jump in long because of this double bottom we have. We've hit a low from, I think this is a couple days ago, kind of Friday. And so we are in long. I'm just going to pull my stop up below this double bottom. And I'm probably just going to go for 2x here. Just because the market is pretty choppy. I'm just going to switch up this indicator here. I'm kind of having some issues with it lately, just to show my actual risk and profit. So I'm smaller size than normal, kind of half size, mainly because this was a pretty bearish move, and the level is it's like kind of like the first retest. But what I like is we have these fair value gap indicators on a 5 minute, and the timing with 8 o'clock reversal is pretty solid, and then a double bottom here. And so I think it looks good for a nice move up. And I'm only going to go for 2x just because of this bearishness that we're having. Also, I've been sleeping like crap, so I just won't be making as good decisions potentially. This is just a pullback. I'm probably gonna have to hold through. I mean, I think with the way this trend is, it needs to have this double bottom and then some kind of fake lower. Once this kind of breaks up here, I think to break to 1x here, I'll probably move here and maybe break even if this really looks like it's going to start to get going. Just because I think it's either, this is a really nice constructive setup now. And I think it's probably going to rip back up here, or it's going to come up here at 50% here and continue lower with the big picture bearishness taking into a play. And, you know, again, I'm just looking for this quick reversal in the morning. And I don't want to put risk on the table if it's just going to not really do what I want it to do. I will say this does not look great. Part of me wants to move my stop up here, take the risk off, because we haven't had a fast bounce. And it seems like the downtrend could pick up, but also in terms of big picture 5 minute, we can still totally come down here and bounce. On a 5 minute on there, 5 minute on here, I mean, like, it would still be totally intact. And then if I got out at break even and I saw a bullish candlestick form right here, I'd be like, oh, I wish I was in that, because it set up a very clean double bottom on a 5 minute. And so I just have to, even though I'm feeling that doubt and nervousness, because it is kind of choppy, I'm just going to hold, and because the main big picture of the trade isn't violated yet. Is there the risk that it goes down? Yes. And I lose? Yes. But I don't want to get out because I'm nervous when there's no real market reason to get out. You know, risk reward is there, and the big picture of moving up and giving back that snap down we had from the market open is totally possible. And so, you know, I think once we break, this is pretty much like a little double top right here. Once we break that, I will move to break even at that point, because at that point it's had its pullback that it should have in an uptrend, and I'll want to get out at that point. But right now it's just this is the first push higher, and it could continue higher after a pullback. Like a NASDAQ here made a new high versus the ES actually didn't. It basically made a double top. So just kind of waiting for that to play out. And that's kind of the hard part about trading. Okay, we're getting a pop here. So I'm going to move to break even now. Sometimes I would move to this low, but if it pulls back off of that, I'm just going to get out. NASDAQ is similar. The 5 minutes, like this is the 5 minute pullback I was looking for. Like I would have still wanted to been in if I got scared and got out there. You know, the trade wasn't violated. With the way the market is, it could still just pull back and knock me out at break even. But again, just managing it. I don't know what's going to happen. I would love to take 2x, but we'll just have to see. So as this gets going here and I get close to this 2x target, I'm going to, especially once we get up to here, like once we start getting a candle up here, up to this price somewhere, I'm going to move my stop loss up pretty aggressively, because there's no point in letting it come up here and then rip all the way back down, right? I'd rather just try and get 2x at the most, but if it's just going to come up here and pull back, I'd rather just get out at like 1.5, because this is a big move up in, you know, a quick move to give this back up, which is great, but it's been kind of a slow market. And so this could really just reverse anytime now at this point. It looks really good to keep going higher, but again, big picture, 50% pullback is, based on this, is just this dot right here is literally right here on the NASDAQ. So we're at the 50%, and ES is past the 50%. So I would love for this to keep going higher, and I think if that's going to happen, it's got this tight trend that it's going to hold. And so I'm going to move up actually to 1x here. I really almost don't want to, because I don't want it to come down here, knock me out, and keep going higher. But in terms of managing it tightly and having this more fixed risk reward of, well, I only have a little bit more profit to make. There's no point in, you know, risking essentially $1,000 to make, you know, another $400. That's kind of how the math adjusts as your trade goes. And so I don't want to give all that back up. And it doesn't make sense math-wise. And so hopefully it holds this, but again, it looks like it could just have a pullback here. And you know, I could have it down here, but you know what? I'm still happy if I get 1x on a trade. It's a long, which is harder to play. It was half size, so I wasn't really super confident in it to begin with. And so I can be super bummed, but I'll be a little bummed just because it does look good. But again, it's given back a lot of the move, and it's not, the market's just not acting great in terms of strength. NASDAQ here, that's a little bit nicer of a bottom to hold. But again, like I think this is, ES is going to hold this and keep going higher if it's going to hold. But this uptrend is already kind of broken. So five-minute NASDAQ just looks cleaner. But again, this is where I'm at. Okay, out for 700. Still happy about it. Still a nice trade. You know, jumped in smaller size because of how I felt about it. And you know, if it just shoots lower here, I will be very happy that I got out. You know, I don't want to play this struggle game of waiting for it to continue higher slowly over and over time. Not every day is going to be, you know, amazing. Follow your strategy. Go with what your read is. That's all you can do.
And so make sure to download that 14-page free Candlestick Patterns guide in the link in the description of this video or with this QR code right here. It'll really help you consistently execute this strategy and show you more patterns that I use to enter in on other than the quick ones I just went through.